What does one do about the exchange rate? The Indian rupee has hit an all-time low on Tuesday thanks to strong dollar bids, while likely intervention by the Reserve Bank of India helped cap losses. Traders told Reuters the rupee hit a record low of 86 rupees 64 paise before closing at 86.63 against the US dollar, down from its close of 86 rupees 57 paise in the previous session. Net, it's well past the 86 rupee mark. The dollar index, meanwhile, was quoted last at 109.5, having just cooled off its two-year peak, which of course gave some breathing room to most Asian currencies which have been on the receiving end. On Monday, the rupee had logged its steepest single-day fall in nearly 2 years, even as the dollar had scaled that two-year high on fading bets of a US interest rate cut this year. But the larger issue, which we will now dive into, is whether the Reserve Bank of India is letting the rupee go. Anecdotal evidence is already pointing in that direction, but it's interesting that a policy of maintaining a tight exchange rate band that was perhaps too dogmatically pursued for the last few years and praised is now being questioned in action, if not in words. And now with the new Reserve Bank governor, their approach seems to be to let the rupee float a little, if not a fair bit. That would suggest that the governors alone are driving the thinking behind exchange rate management or keeping the rupee steady, which of course is difficult to believe. Nevertheless, Bloomberg is quoting internal sources to say that the new governor has shown a willingness to allow the rupee to move more freely in tandem with peers in the region while still intervening in the foreign exchange market to curb excessive moves. Now, this is something that's being or has been advocated by some economists in the last couple of months, possibly triggered by some specific and closed-door briefings. In multiple meetings, the Reserve Bank governor, who took office last month, has shown keen interest in the Reserve Bank's currency intervention functions and expressed no opposition when his team explained the recent movements in the rupee and the need to allow it to depreciate, according to Bloomberg. Under the previous governor, Shaktikanta Das's 6 years at the Reserve Bank, the rupee's volatility fell to the lowest amongst emerging markets, second only to the pegged Hong Kong dollar. The Reserve Bank also built up the world's fourth biggest foreign exchange reserves of more than $700 billion and then used it to defend the currency. Well-known economist and columnist Ajay Shah has argued recently that spells of a managed exchange rate followed by large changes are the worst of all worlds. He says that such a regime lulls firms into complacence, they take on more exchange rate risk and fail to develop organizational capability for the real world where exchange rates fluctuate. And then inevitably, it always happens that the government is no longer able to control the price and a big price change then comes along. The firms, even the good ones, lack the organizational capability to cope with price fluctuations and get hurt, he argues, quoting the example of other industries as well, not just the rupee. So are we at such a point now? More on that coming up. But Shah also says that you cannot buy, for example, flood insurance once the waters start rising. It takes decades for a capable insurance industry to develop. So the firms respond in the political economy, lobbying the government to block price fluctuations, which reinforces the worst elements of the public policy landscape, he argues, saying that this interferes with the main journey of economic growth. He also says that it's always tempting to achieve political objectives or to support firms in genuine distress by preventing the operations of markets. So I reached out to him and began by asking him why he was against a managed currency, which obviously was much lauded in recent years, and also what in his mind should be the Reserve Bank of India's principal focus and emphasis.
The exchange rate is a price, and government management of prices mostly works badly. I mean, this is the core insight of economics. Economics is the study of the price system. That supply and demand make the price, and the price should be seen as information wrapped in an incentive. So when there is a shortage of tomatoes, then the price of tomatoes goes up. So people eat less tomatoes and grow more tomatoes. That's about it. It is as simple as that. And when a government says that, no, I will not allow the price of tomatoes to change, then those responses inside the economy are snuffed out. So you don't have people eating less tomatoes and you don't have people producing more tomatoes. So the imbalance in the economy just persists. Okay, so this is a very generic view of the price system, that the glory of the market economy is all about prices. Everyday prices change and all of us respond to the prices. We don't study the country. We are not obliged to do good things for the country. We only look out for ourselves. We look at the price. We change our behavior based on the price and based on our self-interests. And that's what keeps the whole ship running. So to interfere with prices is really problem at the core. So it is attacking the heart and soul of how the market economy works.
Right. And I'm going to ask you for any other examples from elsewhere, but in a moment. So you've quoted, for example, again, the example of, let's say, steel or lithium ion batteries. I mean, these are product or commodities where prices fluctuate and which in turn obviously sends different demand and supply signals. Now, my question is, can exchange rate or the buying of dollars or the selling of dollars against the rupee be compared to buying, let's say, steel or lithium ion, as you say?
It's a price, there's supply, there's demand. If the government will allow the market to work, which is an if the government will allow the market to work, the market is fully able to discover the price. We have so many countries in the world that are living examples that the exchange rate is a price, the price fluctuates every day, and it solves problems. So, just to help readers, when things are bad in India, you get an exchange rate depreciation that increases Indian export demand. So, companies in India that are exporting do better, and it crimps import demand because foreign goods in India become more expensive. There's no better tonic for the economy than restricting foreigners who are selling goods into India competing with Indian companies and giving additional business to Indian companies who are exporting. It is pitch perfect, and vice versa. When things are very good in India, when the economy is overheating, the exchange rate will appreciate. So it is a stabilizing force that makes everybody's life better. So to allow that exchange rate to do its work is actually a pretty wise thing.
So I'm going to come to the impact of this on firms, and you've talked about that. But before that, so this was not always the strategy, or you feel that this strategy has changed in recent years, and which is why it has maybe, in your view or impression, caused more harm.
So there was a long journey in India where these kind of arguments were played out. So if you begin at the early 90s, there was a long period where Rangarajan was governor and the exchange rate was fixed at 31.37 every single day. So that's where we started. We started from a completely fixed approach. And then over the years, one by one, the economist and the central bank staff and the Ministry of Finance staff grudgingly understood the theoretical idea that, you know what, don't mess with the exchange rate, that it will bite you, it will get you into trouble. Okay, it is the wisdom of practical people that you don't mess with exchange rates. So abundance of interest in managing the exchange rate is the hallmark of people who have not actually experienced macroeconomic policy over long periods of time. And over the years, we got better and better. So while every RBI governor staunchly laid claim that, oh, the exchange rate, we will do a great job, we will make sure nothing goes bad. In fact, in the reality, they kept liberalizing the exchange rate and exchange rate flexibility went up. There were no announcements. But the reality is that exchange rate flexibility went up. So exchange rate flexibility went up with Bimal Jalan. It went up with Y.V. Reddy, who staunchly claimed that the exchange rate is being managed by him. But truly, if you look in the data, exchange rate flexibility went up. Exchange rate flexibility went up further with Subbarao as governor. And so this long run process of emerging as a market economy changed when Raghuram Rajan became governor, when the exchange rate became more managed, and changed even more after 2022 when the exchange rate became highly managed. And I feel that in that period, we lost a shock absorber for the economy. Good news and bad news should play out with the exchange rate, and that stabilizes the economy. And so, actually, the difficulties we've had after 2022 were exacerbated by the new exchange rate policy, which began in about 2022.
But this policy too was never stated, isn't it? I mean, what we are discussing right now.
It's a very unhappy thing that you need to be an econometrician like me to study the data and understand that, oh, the exchange rate regime has changed. That's not a healthy thing in a liberal democracy. In a liberal democracy, the state is obliged to justify and explain every policy action to the people.
Okay, let's talk about the impact on firms. You're arguing that basically this also, in to put it simply, spoils firms or spoils enterprises because they don't have to manage this and they take it for granted.
First of all prices fluctuate. Okay, if you are in business, then your job is to watch that fluctuating world and figure out how to make money. And if you can't handle fluctuating prices, you should not be in business. So first, let's be clear about the burden of responsibility upon firms. If you are a firm, you're here to make money. and all your input prices fluctuate. If you are Britannia and you make biscuits, you are in the game of watching the world where the price of wheat changes, the price of sugar changes, the price of palm oil changes, everything fluctuates. And the job of Britannia is to stand in that fluctuating world and make money. And if you can't do that, you should not be in business. So dealing with fluctuating prices is the business of business. Now, into that, if the government will come along and fix a price, businessmen will say, oh, so nice. It's like my life is being made easier. And they will always applaud. So you will always get positive press by managing an exchange rate. But the thing is, this doesn't work. You can't manage an exchange rate for any extended period of time. The world will always catch up with you, and then you will have a pent up large change which will come along. So, I want to give you an analogy with the prices of petroleum product. So, the Indian government used to have a fixed price of petrol for many days and many months. And actually, a gap would build up, and the difficulties would accelerate because the world price of crude oil would have moved significantly. But in India, we don't allow prices to move. We're a socialistic country. The government controls the price, and the gap would become bigger and bigger. And then one fine day, there would be a big change in the price of petrol, which is actually worse. It's actually more disruptive to have a sudden big change rather than having a large number of small changes every day. And in the case of petrol, this story is largely completed. The Indian state now passes on petrol price changes all the time. We don't do this business of a stop start where we will have a fixed price of petrol for a long time and then suddenly it will change. So now think about the firms who face a relatively fixed exchange rate, and it lulls them to complacence. They stop thinking about the exchange rate. They don't do risk management using derivatives of their own exchange rate exposure, and they actually become soft. What you need is the skill, the strength of managing exchange rate fluctuations all the time. And then suddenly a big change comes, as it inevitably will, because no government can ever fix a price.
So, what could be that gap, the big gap or change that could hit us because we've managed exchange rate so tightly, particularly in recent years?
So we're already seeing a significant INR depreciation, which is catching a lot of people by surprise. Ila Patnaik and I have a paper where we demonstrate that in these periods where there is low exchange rate flexibility, the firms take on more exchange rate risk because they're saying, look, the government is my risk manager. I'm happy to free ride on that. And then when the period of greater exchange rate flexibility comes, the very same firms bring down their own exchange rate exposure. So they know how to do it. They can do it. But you just have this disruptive period in between where a pent up exchange rate movement gets expressed. And then those are turbulent periods. All the currency speculators of the world come onto one side. The jargon in the field is that it's a one-way bet, that by betting on rupee depreciation, I'm only going to make money. And once it smells like that, no amount of power of the Indian state or of the central bank can possibly resist, because ultimately there is more power in the private markets, in private people, as compared to anything that the Indian state can muster. So then you're setting yourself up for a large, messy exchange rate depreciation. It may overshoot. There will be a lot of grief.
We definitely are seeing depreciation right now, hence this conversation. So, do you feel that we're finally letting go? And because some economists have been arguing to this effect in recent months as well.
So there is undoubtedly some depreciation. The proof of the pudding lies in the behavior of RBI. You can't readily see this only in the currency data. In my mind, the two tests are: rule one, that the RBI should not be trading the market. Nobody should do market manipulation of financial markets. If somebody tries to manipulate the share price of Infosys, they should get a SEBI enforcement action against them. Financial markets are the free play of supply and demand, and you should not have any big player trying to control the price. And part two is the RBI now has a legal mandate. They are an inflation targeting central bank. They should be setting their interest rate so as to deliver on a 4% inflation target. They should not have extraneous objectives.
And you've said that RBI should basically focus on inflation and leave everything else to the markets, particularly in the context of foreign exchange.
Set the short-term interest rate so that we will get to the inflation target of 4% CPI. And the exchange rate is not the business of the Reserve Bank of India.
Right. Ajay, it's been a pleasure talking to you. Thank you so much for joining me.
My pleasure.